Hello everyone. When you want to operate your business, you could operate as a sole proprietorship. It means one person. You could operate a business under a partnership where you have a bunch of people working together, or you can operate your business as a corporation. Now, a corporation, you could have one owner, or you could have many owners. It doesn't really matter. In this session, we will discuss advantages and disadvantages as operating your business as a corporation. Now, what is corporation? What is the meaning of that word? It's derived from the word corpus, the Latin word corpus, which is a body, which implies that a corporation is a separate entity, a person, a corpus. Now, as far as the law is concerned, yes, a corporation is a person. A corporation can sign a contract. A corporation can sue someone else. It can be sued. It has certain responsibilities and rights. So when you operate under the corporation structure, what are the advantages? And obviously for everything there are advantages and there are disadvantages. And specifically in this session, we will focus specifically on corporations that are called C corporation, C as in Charlie. Now, why am I making this distinction? Because we also have S as in Sam corporation. And S corporation is more operated for tax purposes. There are tax reasons for that. It's beyond the scope of this course, but in your tax course, you would learn about S corporation. So in this session, we will focus on advantages and disadvantages of C corporation. Obviously, this is the beginning of this lesson, of the series of recording. Then we'll talk about how corporation is started, what are the accounting journal entries, what are the debits, the credits, the financial statements that are generated as a result of this, so on and so forth. Let's go ahead and get started by looking at advantages and disadvantages of a C corporation. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. Advantages. The first thing you want to think about is the corporation. As I mentioned, it's a corpus, it's a body, it's a separate legal entity, and this is very important. Why? Because if it's a separate legal entity in the eyes of the law, the owners are granted limited liability. It means the corporation and the owners are two separate legal entities. The corporation enters into a contract, the corporation is sued, the corporation can sue other parties. This means your personal asset, the personal asset of the investor or investors, are protected. In what sense? It means you can lose from that corporation the money you have invested, period. So the most you can lose is the money you have invested. No one can come after you personally. So let's assume you own a deli or you own a business and it's incorporated. You and the business are two separate entities. Let's assume someone walks into the store, into that deli, into that restaurant, and they fall. Well, they would sue the corporation, the restaurant, because the corporation is a separate entity from the owner. The maximum amount that the owner can use is the money that's invested in that business. And that's important for legal liability. You have a limited liability. 2, transfer ownership. Ownership in a corporation is easily transferable. especially if we are looking at publicly traded companies. Why? Because you can sell your stock. For example, you can buy and sell Amazon shares at any time. That's easy. You can transfer the price. This ease of transferability is not as simple in privately held corporation. Why? Because in a privately held corporation, there may not be a stock market, but you could always find someone to buy your ownership, maybe other investors, maybe someone who's interested in buying some shares in that company. For example, I always like to buy shares in a company called Wawa. If you're in the eastern Pennsylvania or northeast, or Florida for that matter, it's a convenience store. It's a privately held company. If I want to buy the shares, I have to find someone that owns the shares, and they have to be willing and be able to sell the shares. Sometimes the corporation might place restriction. But generally speaking, if you want to buy and sell your stock in a C corporation, publicly traded, it's very easy. It's very easy. It's significant advantage for publicly traded ones because I can invest the money. If I need my money back, I can easily sell it. More advantages is the continuous life of the corporation. The corporation can continue to exist beyond the lifespan of their owner or owners. For example, when Steve Jobs passed away, Apple continued to operate. I mean, this is, Apple is a conglomerate. It's one of the biggest, largest corporation, but I'm trying to make the point here that the corporation should be able, especially large corporation, will survive their founders, their owners. Another advantage of a corporation is there's no mutual agency for stockholders. What does that mean? Owning stock in a corporation, let's assume Amazon, does not give you the authority to act on behalf of the company. The authority nor the obligation. Although you're the owner, you don't have to work for the corporation. Although you're the owner, you cannot act on behalf of the corporation unless obviously you hold the formal position. You also work for the corporation, which is possible. You can own stocks and work for the company. But as a stockholders, you have no obligation. But you're saying, hold on a second, I own the company. So what are my advantages? Just hold on that, because the stockholders will have certain rights. We'll talk about those rights in the next session. But one advantage of holding stocks in a company, it means you are an owner without having to work. In a sense, you don't have to work unless you are an employee of that corporation, but you have no mutual agency. You don't have to represent the company. And this is going to be different when we talk about the partnership. Now, obviously, if you're a sole proprietorship, you own a business, you're an entrepreneur, you have to work for the company as you are the owner, not for a corporation unless you hold a formal position, management, employee, or some other capacity. You could also be on the board of directors for that matter. Another advantage of corporation is the easier capital accumulation. Again, here we're talking about publicly traded corporation because they're large enough, they're well known. If they want to raise money, they can sell new shares of stocks. And this is what we will discuss later on, the accounting aspect of issuing or selling shares. If you're a corporation, it's easier because you can take the shares and sell the shares, distribute the shares to investors who are willing to give you money when needed. Now, having said so, it doesn't mean every time the company sells shares, it's a good thing for the company. Yes, if you have a good business plan and the investors are interested in investing in your business, it's easier to sell shares. However, if you're in trouble and you're trying to sell shares, it may not be as easy because the market condition will determine this. But being incorporated will make the logistics easier because you already have the shares available. The stocks are available because they are issued. Now, how are they issued? We'll talk about this in the next session when we talk about how the corporation is incorporated. We'll talk about authorized, issued, and outstanding. So generally speaking, it's easier to accumulate capital. Again, just because you're a corporation, no one's going to give you money. You have to be a corporation, have a good business plan, and people are interested in your business. Now, those are some of the advantages. Maybe you can think of other advantages, but let's talk about disadvantages. One of the main disadvantages of being a corporation is the government breathing down your neck, government regulation, especially if you're a publicly traded corporation. Public corporations face stringent government regulation, especially from bodies like the SEC's Security and Exchange Commission. You have to file so many different reports. You have to comply with different things. SOX compliance, quarterly reporting, annual reporting. When something happened in the company, you have to formally report it. So these regulations add cost to the company, especially when it comes to internal control compliance, SOX 104, which we'll talk about this in the audit course. But once you're a publicly traded corporation, you are under the government regulation, federal, state, and what do they require? They require different reporting requirements. What does that mean? Cost. They require you to have an audit. What does that mean? Additional cost. So government regulation is one of the main reasons why some companies don't go public, because they don't want the government breathing down their neck. The government is already breathing down your neck with taxes, which we'll talk about in a second. But being publicly traded, you give them more room to do that because you're publicly traded. The government's job is to protect the public. When it comes to taxation too, C corporations are subject to double taxation. That's another disadvantage, especially for small corporation. Now, large corporation, they have to be a C corporation, but small corporation, they will try to avoid the C corporation because of the double taxation. Now, you're saying, well, if they avoid it, they would lose the liability. There are other options to protect your liability as an investor, but that's beyond the scope of this discussion. But C corporation, they face another disadvantage, and that's double taxation. So what does it mean, double taxation? As we started this session, we said the owners of the company and the corporation are two separate entities. So let's assume two separate entities. Let's assume it's a corporation. The corporation generated revenues, incurred expenses, $10 million in revenues, $6 million in expenses. There's a profit of $4 million. Now, the corporation is a separate legal entity. What does that mean? It means if it's a separate legal entity, it's going to pay its own taxes. Well, what's going to happen is this. And let's assume for the sake of illustration, we're going to assume the taxes are 20%. So the company will pay 20% in taxes, which will bring the tax bill to $800,000. So $4 million minus the taxes of 800, what's left to the owners are $3.2 million. And for the sake of simplicity, you could have thousands or millions of owners. Let's assume you only have one owner to make the point. Now, this $3.2 million is distributed in dividend. Again, we're making this assumption. And what's dividend? Dividend is when the corporation distribute the money to the shareholders in form of dividend. And we'll talk about dividend later, but that's good enough for now. Once the owner received that dividend, $3.2 million, guess what? The owner is a separate entity than the corporation. As far as the government are concerned, the owner will have to pay taxes. And we're going to assume the tax rate of the owner is 30%. How did I come up with 30%? I just made that number up. It could be 30, 33, 25. So I'm going to assume it's 30. Now, the owner will pay $960,000 in taxes. So notice what happened here. Let me highlight in yellow. The corporation paid $800,000. The owners paid $960,000. So if we take $960 plus $800,000, we're talking about $1.7 million in taxes between the two on a profit of how much? $400,000. This is where the double taxation comes from. Now, this is in theory. This is legally what should happen if the company distribute the dividend. This is what would actually happen. Now, in the real world, there are other ways to avoid this double taxation. But in theory, this is what could happen. And it could happen with some people. What do I mean by this? Let's assume that's your business, that's your profit, and that's your only business. You need to take that profit out to live off that profit, or you are forced to take it for one reason or another, then you are subject to double taxation. So first, the corporation paid the taxes on its profit, as we saw the $800,000. Then when the profit are distributed, the shareholder must pay taxes on the dividend, as we saw the $960,000. This means that the same income is taxed twice, which is a significant disadvantage compared to other business structure. And we talked about other business structure in other recording, sole proprietorship, partnership, which we'll have a whole chapter about partnership next. talking about their taxation, but this is a significant disadvantage. So what we did in this session basically looked at advantages and disadvantages of being a C as in Charlie corporation, not S corporation, S as in Sam. We're not talking about S corporation. That's totally separate. If you want to learn about the taxation of S corporation, go to FAR lectures to my taxation course, and that's heavily covered, as well as C corporation for that matter. What should you do now? You want to go to FAR lectures, look at additional MCQs to reinforce, to learn more about this important topic. In the next session, we will start to look at the corporation, basic terms, how the corporation start, incorporate. We look at the equity section, then we'll get into the accounting aspect of it. Stay motivated. Good luck, everyone, and invest in yourself.